Hello, good afternoon, ladies and gentlemen. It's investment show, Modern Finance on IBM Pod TV. My name is Sasha Starr. I would like to introduce our panel for today. It's founder of the network, Nick Paliveda. Welcome to the show. And we have former Wall Street professional, Peter Bennett. Welcome to the show. And finally, not lastly, is obviously Milan Sombrok. Welcome to the show.
Delighted to be here. Thank you.
Yes, and he would like to start show as usual with Peter's latest news relevant to our investments.
Okay,
Please.
all the new news you need to know. So the news has not been good again, basically. Everybody knows this part. But I would point out that this show has been talking about a lot of the things that people are now talking about all over the place for about 9 months now, at least, about the energy and recession, and that was, endangered the stock market. Anyway, so Goldman Sachs said they raised their chances of a recession from 15 to 30%, which is very low to me, and also most people disagree. Tom Dudley did an interview this morning. He was on the New York Fed. I guess he ran the New York Fed, and he said that now, in his opinion, it's extremely unlikely we're going to avoid a recession. Former Treasury Secretary Larry Summers had a quote that I thought was interesting. He said, "Without a near-term substantial increase in unemployment, it's improbable that the Fed will tame inflation." And he said, but unemployment now is still near historic lows. So, that's the problem. You've got very strong unemployment, but how do you reduce demand when there's strong unemployment? It takes a lot of pain. And that's a term I was listening to when Congress was grilling Fed Chairman Powell this morning. They were saying that, how do we avoid the pain? And he admitted he can't really control, which we know, energy and food prices. So, but he still has to reduce demand in the economy. In energy front, the Netherlands is now reverting back to coal, and they've just eliminating their prohibitions on coal because they need energy. They're joining Germany, Austria, and Italy on that front. So there's two things happening there. Obviously, the Ukraine war is draining Europe of energy, but also because they're trying to transition too quickly. So because of that transition, as I've said many times, last year we burned more carbon in the United States and more carbon worldwide than other years. And why is that? Because they're transitioning incompetently, basically. And instead of focusing on working with the energy companies, transitioning to natural gas, for instance, people are now using oil more and coal more. It turns out coal has been a great investment, although I wasn't in that one. Another energy front, Tom Goldstein, I think I got his name right. He did an interview this morning too, and he said, and he's from the International Energy Administration. And he had two really interesting points, I thought. He said, one, energy companies are now investing 50% less capital than they did in 2014. And that's a point I brought up in different forms, but it just shows it's just another way of saying it. Just like Moody's say we need 57% more energy investment, the energy companies are not going to invest in this environment in big scales because of so many reasons, including the regulatory environment and in terms of their businesses being terminal. They're not going to put every dollar in until it goes to zero. But they had he had another interesting point, and he said world oil exports are actually pretty flat over the last year. And you go, wait a minute, what about Russia? And what is happening, and I believe I understood him perfectly well when he's saying this. I believe what's happening is Russia is sending their oil to China, by the way, at a big discount, so it's not great for Russia, but they're sending their oil to China and India. And India, and I believe China too, but definitely India, is refining the oil and sending it to the West. So the West, exactly, Nick. So the West is getting the oil from Russia. It's just going through a different channel. So this is, it's just surprising in a way. But it also tells you oil prices are so high, but we're still getting Russian oil, unfortunately. So the White House press secretary comes out and says, quote, "We don't need to drill more." It's like, okay, no, I'm not going to comment on that. And Biden called for refiners to increase production. The only problem with this is refiners are operating at over 90% production levels right now, and they're expected to hit 96% over the summer. So basically, they're pretty much running at full capacity because they can't do 100. There's, you have to take down for equipment, recycling and, repairs, things like that. So basically, they can't do it even if they wanted to. So why is he just doing that? Who knows? In crypto, another crypto lending company, Babel, just halted withdrawals. I think it was over the last weekend. There's the second one, and that's accelerating the Bitcoin collapse because people are funding crypto as beanie babies, which basically is, or tulips in Holland. And that's something we've been talking about. Everybody on the show has been talking about this for a long time. It's highly, highly speculative, and the IRS has new regs that are going to decimate it. And in the end, a digital currency will go. And finally, for the news for now, in a recent article I read, that was in Barron's, it turns out analysts are still forecasting very rosy pictures on Wall Street. So they're forecasting, and I don't know the exact date that this article came out, but it was in the last few weeks. They were forecasting 11% growth in earnings in 22 and 10% growth roughly in 2023. Now, that's a very rosy picture. And I did hear in one story somebody saying, why are the analysts not changing their forecasts? Earnings went down, I believe, 15% last quarter. And they said, well, the analysts want to stick to their guns because they don't want to look bad. So once they, I guess, take a position, just like anybody in an argument, they're reluctant to change their position. It's human nature. So I think Wall Street's in for an awakening because consumer spending is 70% of the economy, and the consumer is getting crimped by everything going on. So that's the news for now.
Peter, one quick question. How would you explain the drop in a few days in the price of oil from 120 to 106?
Oh, that's an easy one. People are forecasting recession. So they think, but this is the problem with, I think it's going to be much worse than that, what they think. But they're forecasting a recession, which I believe is almost inevitable. I think it's highly likely because if inflation doesn't do it, the Fed will. It's one or the other, but it's both. The Fed is going to try to fight inflation. I don't think they can. And inflation is crushing the consumer. I mean, all you have to do is go to the grocery. Not everybody can afford these prices, and gasoline is at $5 a gallon, and who knows where it's going to, and not to mention in 6 months the reserves come out. They're issuing, Biden has 1 million barrels a day supplementing the oil supplies of the United States right now, but he's using up our reserves, which I don't think is a good tactic, and which, by the way, Trump bought at $40 a barrel and was complained about at the time, but now he's releasing it at a much higher price. But the thing is, he can't do that forever. So what happens next year when the reserves are gone and he can't play that card? So, but here's the answer. So if we go into a recession, it's going to hurt demand. But that's the unknown. How high does inflation have to go and prices have to go before demand goes down enough to meet this energy crisis. And I think it's pretty high because the elasticity of oil is 5%. So that means if it goes up $100, or 100%, it reduces. I should say 100%. It reduces demand by 5%. And people have money in their pockets right now, and they're going to cut back on restaurants, on discretionary entertainment, maybe travel, but people are still going to drive. To me, I don't know where you are, and I'll put this to the panel because we're in different locations. But to me, I'm on the roads all the time, on a weekend or during the week, different hours. And I'm always shocked at how many cars are on the road. It could be like last Saturday, it was 12 o'clock noon, and it was almost like a traffic jam in Westchester. And it's like, normally that wouldn't be that crowded. So what about where you are too, in Canada and down south? I think and by the way, when I went to Utah, it was the same thing. There was cars everywhere. It's just jammed. So people aren't getting off the road too easily. It's going to take a lot of pricing. And I think that it's going to take a lot of pain.
Well, it's a matter of a lifestyle. The driving is much ingrained in North America culture. That I mean, what are you going to do? You want to do bicycle trips for groceries?
Well,
So,
well.
Milan, actually, you may comment on that because I know that you are a private user of bicycle. So maybe that's an answer.
Just so that we're all reading off the same page, please define a recession.
Well, we're probably in one now. I guess there's different definitions, but I mean the official definition, I believe, is 2 quarters of declining growth.
Exactly. And
and I think that we're probably going to have one in this quarter. But I think when I say recession, I'm just talking about. I mean, there's different ways to put it, but in a generic, I'm talking about more pain to come. I'm talking about a lot more pain to come in terms of the consumer, in terms of the economy, probably in terms of the stock market. I mean, nobody can know for sure, but I don't like the way things are looking because there's no easy solutions here. Because, like you said, people aren't going to want to switch to bicycles. So what dollar amount for gasoline because supply always has to meet demand, right? We learn this in economics. Boom, supply and demand curve. This is like economics 101. So at some point, either supply has to increase, which I don't think is going to increase a lot, or demand has to go down. But what's going to force those people to say, okay, maybe they'll cut some vacations, but what's going to force people to say, okay, I'm going to get on a bicycle? It might take a lot more price.
Yeah.
Well, what I've heard lately on CNBC, which all of us are watching, they're saying that there is a bearish indicators for oil and oil companies' shares, and that's been shown for the last several days, and it keeps going down from 120 or so, now 106, and it may go lower even then.
It might
So
in the short run.
if that's the case, then the overall inflation, because almost all prices for food, for groceries, for anything, that includes price of gasoline. So if gasoline is even not going down from their own, but at least stay the same way for the next, I don't know, week or two, then the overall inflation will go down naturally because the prices will include cheaper gasoline than it used to be even a couple of weeks ago.
It will help, Sasha, but wait. But first of all the food we're eating now has been produced. A lot of it was already grown. It cost. The fertilizer was paid for, and the fertilizer is made up largely of energy, natural gas, and energy. So those costs already went in. Everything, it's like going through a snake.
So
Things take time.
yeah, but you're talking about the high prices now because they include high oil prices of 120 or some. So if the next week or two or even month, prices will not go down, but just remains the same. So all inflation factors as the food and fertilizers and everything else will also go down. So the figures for inflation will go overall down. So I would expect that next report will show definitely the number for inflation must go down.
I hope so.
Well,
I
I
hope
don't,
so.
I
I
don't,
mean, I had a chart. Remember, I had a chart that everybody thought it was going to go to 8.2, but it's been going up and up and up. But here's the problem that I think too. Look, it's at 8.6 now CPI, and as I've
yeah.
said before, if you look at it based on the way they used to report inflation in the 70s, it would might be 14%. The government is now using these methods for many years now of substituting. So if you can't buy carrots, you can buy spinach. And spinach is cheaper, but life doesn't quite work that way. You can't, and it's very tricky how they do this because they okay, your car may cost $50,000 now or 40,000, but it's a better car, so they adjust for that. So
Okay.
because now you have a computer in your car, but it
all
still
of,
costs that much to live.
okay,
So
our discussion should
yeah,
hopefully help our listeners to make prudent investment decisions. And based on what we are telling them now,
mhm.
they should go and buy energy stocks, or like what are we
No, I
trying?
don't think so.
What
I
are we
I
trying
I
to
only have one energy. Here's the thing. I am out of the energy stocks, and I'll get into that more. I'm going back to MPLX as my dividend stock of the week. But um, here's the thing: the energy companies are faced with long-term dilemmas because they have to get supply. Costs them more and more to get supply because they have to go out in the middle of the ocean to get it. It's much more expensive to get it. So, and they have to get always supply, and then they have to make profits. They're under attack for many reasons, and maybe in 10 or 20, 30 years they won't be in business or they'll be hurt a lot. There's forecasts from BP that under the rapid transition focus that oil will only be one third as much used in 2050. So you say, well, maybe this isn't a good business. Now, if I'm getting a 3% dividend on Exxon or whatever it is today, or one of these stocks, it's like, then I get my money back in 30 years. Maybe I get some dividend increases, but maybe I don't because they have to keep reinvesting. Plus, now they're investing a lot in ESG, which costs them a lot. So
so
it's all pipelines to me
so
because the pipeline industry
does it make
made.
does it make sense to short energy stocks?
I never have the courage to short anything because I hate to lose money. But it might. I don't know. I just like to find good. The danger in shorting is that you just never know. Like a company
Yeah.
can look terrible and they can make a deal or a merger or figure something out. So I just like to find really good companies that have great cash flows or maybe do an option or two like you do. Where you sell an option, but I like to make sure bets basically. So, but the real opportunities in the um, midstream partnerships like the MLPs because they correlate with oil. So I'll get into it right now in a way because this is my dividend stock of the week, which is the discussion because it just fits right so nicely. So MPLX crashed along with some of the others, not crashed, but it went down a lot. But
Almost 20%.
right. So I'll talk more about the dividend and everything later. But the point is, these should be treated like utilities, the midstreams, because people need that, especially the natural gas ones, which I prefer, because people need to heat their homes and they need to have fertilizer and so these MLPs are not going down in ultimate fundamental value because they're necessities, just like your electric company, has to power your home, where you have to get power somewhere. So, but these things have historic returns of 17% a year and huge dividends, but they trade with oil, which makes no sense. And I could only think of reasons why. One is maybe mutual funds that hold the oil have to sell the MLPs when they go down. But I actually think it's just pure market manipulation. I think that, because it doesn't make sense. Why would a natural gas oriented MLP crash because oil went down a lot in one day when it's like a utility and it's paying 10%? To me, I think they just try to force it's largely retail investors, by the way. A lot of institutions don't do it. So it's easy to push them around, maybe. So they push it down and then they push it up and they trade. There's so much manipulation, as you know, Sasha.
So,
So,
Yes, please, Milan.
can I make a comment?
sure.
Okay. Uh, this is a little bit of an aside, but when I was a student more than 50 years ago, I greatly admired Claude Bissell, who was the president of the University of Toronto. Claude Bissell took to work public transportation. He had at his disposal a chauffeur-driven Rolls Royce.
Wow.
Now, I was a kid in my 20s. How could I possibly admire this man's intellectual achievements? But I did admire the fact that he and I were on the same bus going to the university. And so I was reading about him, and recently he said something that really applies, I think, to investment. He said, risk more than others think is safe. Care more than others think is wise. Dream more than other things is practical, and expect more than others thinks is possible.
That's
Based on that philosophy, he tripled the size of the University of Toronto, one of the world's leading universities. And that philosophy, that approach, is perhaps something that all investors could use, not just in investing, but in life. Now, back to energy. Scientific American more than 40 years ago predicted that oil and gas will disappear as an energy source by 2030.
Right.
It's not that far away from now. Now, oil and gas have a lot of other uses, more than a dozen, more than 3 dozen uses. Some of the clothing we're wearing comes from, made from fiber that is made from oil and gas, and the applications are enormous, but energy is the biggest source of applications for oil and gas. Interestingly, France right now derives over 70% of its electricity from nuclear sources. Denmark, 50% from wind. And listen to this one: British Columbia, Manitoba, Quebec, Newfoundland, and Labrador get 95% of their electricity from water, from hydro. And that is possible. You know, Egypt has built that Aswan Dam not that long ago, so they get more and more energy converted to electricity through hydro. And so those things are possible, you know. So in the short term, things are not looking so good. We could well be in a recession as defined by 2 declining quarters. But in the long term, there's a lot to be optimistic about.
Yeah, well, but you know, on one side you're right, Milan, and you know these are great sources of power. Hydro, you know, solar is coming. There are improvements in solar, but it's a slow transition. You know, and it's not going to happen overnight. But first of all, people are trying to force it too quickly, and that's not working well, as the economy shows. But also, and if you look at the percentages, I'd have to pull it up, but it's something like maybe 8% of all our power right now is coming from all of these renewable sources. You know, it's a very low percentage, but it's increasing, and it's going to increase. But even then, there's a lot of forecasts that even in 2050, we're going to be using more renewables and more hydro and more solar, but that oil and natural gas use is going to go up probably either way, but oil even may go up under forecast. And why is that? Well, one thing, the world population is forecast to go from 8 billion to about 10 billion by 2050. Now, not only do you have 2 billion more consumers, but you also have people in poor countries that are saying, I don't have gas to cook with. I don't have a car. You know, as wealth spreads out around the world, which it has been doing, more and more people say, I want a cell phone, I want electricity, I want to cook with heat. And so this increases demand too. So the renewal effort is great, but it's not going to replace natural gas and probably maybe not even oil for a long, long time.
You know, Peter, all species become extinct sooner or later.
No, please.
And that includes Homo sapiens.
It could happen, but I hope not. It'll be like
it is sooner. But look at the sources of our disappearance that exist right now: nuclear weapons.
No, I know.
Pollution.
I know.
And who knows what else? Hunger. It's not looking. In the long term, it's not
issues.
Good. So
There's
enjoy the
issues,
day. Because the day will come, we won't be here anymore. Guaranteed.
Nick, please give your
Nick.
Your view.
Oh, Nick, we can't hear you. You're on mute.
Okay, when you're dead, all your problems go away. So the thing is, we have to deal with what we're doing when we're alive, and that's when we have all the problems. Problem that I'm facing right now is the Federal Reserve says they're holding back another bullet, which may take place as early as next month, another almost a point interest rate increase. And if they fire that bullet again, which I would have no doubt that they're going to do it,
Probably.
watch the stock market collapse again. In other words, take another sink. And that's the problem I'm having. Otherwise, Peter, I'd be all in with MPLX. But I did watch my MPLX fall relative to the market, and I'm going like, wait a minute. And then I got Powell sitting over there with his gun saying, I'm going to shoot you again with another 3/4 of a point. Well, that's going to drive interest rates to what? 7%?
No, I don't think so. I'll tell you why. I think that what's going to happen is we're going to have a flattening of the yield curve, which is what happens in recessions. So, I mean, the Fed is very low right now. I have to look it up, but they're at like 1.5 now, I think. So when they're raising the very short end. But so the long end has already gone up a lot, which is why, and I'm torn on this, but I've been buying, like I bought a 3.6% treasury in my IRA the other day.
That's pretty good.
Long term, like 20, 30 years, and I've been buying a lot. I had no treasuries, and now I have 10% treasuries long term, because I think that here's what I think is going to happen. I think we're going to have a lot of inflation and then a lot of pain. I think then at some point, once prices go up a certain amount, let's say prices go up 25% and it crushes the economy. At that point, you might have zero inflation for a long time. Why? Because the price is already high. They won't go down, but they'll be high enough to crush people.
But Peter, wait a minute. When you buy treasuries at 3.6% and inflation is 5%, haven't you just locked in your losses?
No, because I don't think inflation will stay there, because I think what's going to happen is there are huge deflationary forces in the long run in our economy. Robots are coming. And I have a piece by Elon Musk, by the way, that's brilliant, that one of these shows, I'll throw it in there. But he talks about AI. Look, if anybody look at dancing robots on Google, just Google dancing robots for the audience and for you. You will not believe what these dancing robots can do. They're like ballerinas.
Well, I was tempted to invest in Mizo because of that.
So you take Alexa and you put it inside a dancing robot, and that thing can do the work of a lot of people, and robots are coming. So in 5 years, 10 years, that's going to hurt labor a lot. And so in the long run, also an aging population is deflationary. Plus, the government is going to have to force rates to zero because of the debt. They cannot afford.
Ultimately have to go.
They are going to use what's called yield curve control to force it down. They've done it before in World War II. Japan's doing it now. Many countries are doing it now. So they're going to force rates down so that they don't have to pay interest on their debt, and that would be even more inflationary. So tell me that right now it may look like I may lose a little money, but in 5 years, 10 years, these bonds are going to be generating 3.5%. And let me just add, in a worst case scenario, I'll just take my interest on my bonds and my MLPs and my stocks and my earnings, and I'll just buy some bonds at higher rates if I can get them, but I don't think I can get them much higher.
May I say something that might surprise a lot of investors?
Sure.
If people invest the way that we recommended Monday morning, which means money that we're going to need in the next 2 or 3 years does not belong in the stock market, and then we have an asset allocation where we have a very high percentage of cash, say 50-50, 50% in the American market, 50% in cash. And then as the market goes up, we take profits to rebalance to 50-50. As it goes down, we buy bargains to balance at 50-50. So people with this mindset are just as happy to see a declining market as they are a rising market. They're winners all the time.
Wait, but that assumes one thing, Milan, right? It assumes that it assumes the market will be up in a fair amount in 10 and 20 years. But it is not uncommon, first of all, for the market to go through 10-year cycles of flat or
that's true. Yeah.
So
you seldom have flat markets,
No, seldom, but also the Fed Reserve has the reason the market's done so well, and you can look in the past 20 and 30 years, is the Federal Reserve has been pumping the market up by decreasing interest rates. But that game, once they go to zero, that game's over.
That's
right.
In Japan.
I'm not saying it's terrible strategy, because I don't know. But I like a nice dividend stock that I know no matter what happens to the price of the stock, I'm going to get my flow, and then maybe I'll get some appreciation too, hopefully. And also,
Maybe.
dividend stocks do
You know,
outperform the S&P.
if you buy a stock, you're buying it from somebody who is selling it.
That's
Both of
true.
you cannot be right. You have a 50% chance of being wrong and a 50% chance of being right. And those kind of odds is something that we discourage our members. We have about 400 followers in this Monday
Okay.
Millionaire. And we talk about how, which every transaction, one of the parties is right and the other one of the parties is wrong. It cannot be any other way.
Wait, but then
Therefore,
what about the S&P 500? If I sell the S&P 500, somebody else is buying the S&P
yeah, that's right.
500. So it's also 50-50, right? By your
Yeah.
logic.
Yeah, that's right. Yeah, S&P 500 right now. I heard you say recently, Peter, that you wouldn't touch it. It's a bargain now. You should be touching.
I think it will be a bargain, but it's not a bargain yet, in my opinion.
Well,
Nobody knows.
Yeah, that's the only question I have. It's really a matter of timing. I mean, if they
Right.
increase interest rates, and also the analyst I've been reading saying, hey, things are going to come back in October. They don't say now. Summer could be really bad. So I'm looking to buy. Like I said, my idea is real simple: buy low, sell high. What's wrong with that? You know, the real problem is, of course, finding when the low is going to be.
Well, it's hard to catch that
You know,
knife, right?
Well, it's hard to catch the exact low, Peter.
Oh,
as you
yeah.
know.
Or
Don't
any-
even
yeah,
try.
it is.
Don't even
You
try.
can catch pretty close to the low and just be good with it, and then you can catch pretty high, close to the high. So I liquidated out. So I'm sitting on like a ton of cash when Sasha says, "Get out of market, it's going to go down." So I got out of market and it went down. So I'm sitting on a ton of cash. The problem with sitting on cash, in an inflationary environment, if I just keep sitting
Of
there,
course.
I keep
Oh, yeah.
losing money because the thing is, the purchasing power keeps going up and my cash just doesn't go up. So I'm interested in hearing your thoughts on MPLX because that was going to be my all-in strategy. The only question is,
Okay. Well,
when?
first of all, don't put it all in there. That's my first
I
thought.
won't put all of it in, but I'll put
It's still
lot.
a company, so you never know. As a matter of fact, I mean, I had gotten to the point recently. I was kind of lucky in a way, but MPLX went up to like 33 and whatever, and I went, wait a minute, this is over 25% of my portfolio now. I can't take it anymore. So I sold some at 33, some at 30, and because I was trying to be rational and saying I shouldn't have that percentage in there. It's a big, just by allocation methods. Many people say don't put more than 5% or especially more than 10% in a stock. So then it went down. And then I sold it on the way down a bunch, and then I went to 12%, but then it went down. Now I picked it up to 15%, and I'm going to just sit here. That's my new strategy. At 28, I love it. The stock is, first of all, it is like a utility. Second of all, it has a 9.7% dividend today. Its price over cash flow, which I always look at, is 6.62, which is like a 15% cash flow yield. Now that 15% cash flow yield does not include all the money they put in, the projects that are coming online. And this is why generally the midstream sector has a 17% rate of return, except it really got hurt in maybe over 3 or 4 years when oil went down to almost zero. I mean, it was negative at one point. So that was painful for the industry, but MPLX came through fine. So anyway, this is, to me, I like MPLX, I like EPD, I like USAC. The only oil company I have is BSM, but these are much smaller allocations. I have 1% in that because it's a royalty trust, but they all have, you're looking at 7 to 10% yields. Of course, you have the benefits and the issues with owning an MLP, but because it raises your accounting cost. But the other side is there's huge benefits. You don't actually pay tax until you get all your money back. And it's even longer than that because you get your depreciation and depletion. So I'm not expecting to pay tax on this forever, and I'll get all my money back outside of a disaster. So yeah, MPLX is a winner, and it's down a lot today. Even I bought a little more today when it was even a little lower. But now I'm just going to hold. I don't want to own more than 15% in one stock, even though I love it. But the others are smaller, as I said.
Is it possible, Peter, for everybody to do that well?
To do what well?
Is it possible for all investors to do as well as you are doing?
No, because Peter thinks.
Some people, there are billionaires. I don't know. There are billionaires out there,
See, a lot of the investors, they don't.
I'm not a billionaire.
They don't do their homework. They don't think. Remember, there's this person you're probably familiar with called Kathy Wood.
Yeah.
Okay.
Right.
Oh yeah,
How's she doing
Yeah.
anyway?
Yeah.
Here's
not
Kathy.
good.
Not doing good. Okay, but the thing
No,
is,
horrible.
we discussed her months ago, Peter, and we were thinking that her strategies were out of control. And then the thing is, there was these group of investors we also discussed on our show, the crypto crazies. Okay, the
Oh, yeah.
crypto crazies we were totally out of, So I think, Milan, what you have out there, you're right. It's like chess, as Sasha says. Half the chess players will win, half the chess players will lose. But
No,
the
no,
good
no,
chess
no, no.
players
That's good.
are going to win a lot more than the bad chess players, right?
That's true.
That's
Okay.
not
Very
true.
good. Son.
And some of the best chess players in the world are also really good at investing.
No, that's
Right.
not true, by the way, Nick. Most chess games end in a draw.
In a draw. Okay, so
In a
they
draw.
can
You
draw.
don't have a
They
draw
get
in the
draws
stock
too.
market.
Yeah.
You
But
don't
the
have
thing is, you can apply analytical skills to the market, which is the reason I like it. Otherwise, you might as well go to Vegas and bet on the roulette wheel. But
Oh,
here,
exactly.
you can actually apply a certain amount of analytical skills and research to increase your odds to be better than 50-50. I'll look at it this way: I only have to be better than half the people out there that are investing. That's it. To do better than the average investor, you only have to be better than half. I'm not used to competing at
Yeah,
such a
but
low level. So the thing is, I'm used to competing at a very high level.
Yeah, that's true.
It's like at chess. If you could put me in with just regular chess players that think they play chess, are all going to lose. But if you compete at the highest level, it's a whole different cat. So I like my chances in the market because I like my competition. It's weak. It's just normal people. Am I missing something, Sasha?
And plus, I mean,
Well,
and
what I would
plus what you
say,
said, Milan, about outworking. I mean,
Sure.
nobody I know spends, maybe some professionals, maybe not even professionals. I spend so much time working on this
That's
every
right.
week.
And
I
see,
mean,
all I'm doing
because
is I'm
I
bleeding
like
your
it. It's not
brain.
just about making money, but I'm just interested.
That's what I'm saying.
I'm a news junkie.
Okay. And see,
so
Milan, all I'm doing is bleeding Peter's brain. Peter spends all his time working the market. I go, and then I
Yeah.
press the button. Yeah, I'll go bet.
This
What's
will
wrong with that?
interest you. We did a survey of our members who are many of whom are either close to retirement or retired, and they have portfolios ranging between $2 to $5 million. And they equal the market by buying an exchange traded fund which tracks the S&P 500. Equaling the market is something you can teach a high school student in 10
that's
minutes.
true.
Right.
Beating the market is next to impossible. Long term.
It's
Short
tough.
term, yes, people can beat the market. Long term, very few do it.
That's right. Very, very few, but there are very few
So
that
now,
do.
if we're happy with the
Right. Very
return,
few people are grandmaster chess players.
And
You
very
know
few
what? There's
people are grandmaster chess
there's
players.
3 chess players on this, panel. Sasha, Nick is the 3-time Florida champion. I used to play
Three
Nick,
times.
and you know what? I could beat almost anybody in chess. But when I used to play Nick, I was so proud. I beat him like I think twice or 3 times. But we were playing every day. But I'm just saying, chess teaches you a lot about being 4 steps ahead, 8 steps ahead. That's what the whole game is about. So, and investing's the same way in a lot of ways. Just like Sasha talks about,
If
you
you're
buy an
happy-
options position,
if
and
you're
when I
happy-
take position, I say, what's the next play in case it doesn't work out. So
Right.
then you have another play and another play and another play.
if you're happy with the return of the S&P 500, the S&P 500 was launched, I think, in 1957. But let's say if you're happy with the returns of the American market, say the Dow Jones Industrial Index, as far back as it goes, let's say 200 years, it's given an average return of 10% annually, not inflation adjusted, or 6.5%, yes, inflation adjusted. So these members of ours who have these portfolios between $2 to $5 million spend 15 minutes a week managing their
It is simple. Are these dentists?
Sure.
Are these dentists,
Look,
by the way, Milan?
Sorry?
Are they
These
done?
dentists? Who are these members that you're
Yeah.
talking about?
Mostly dentists, veterinarians, and optometrists.
Okay, so they're people who make pretty good money. Dentists.
Yeah, right. Yeah, they're
Dentists,
making good money.
You're right. They
and-
don't need to be aggressive, and
Right.
you're right. Listen, the S&P has been great. The real question is, what's it going to do in the next 20 years? If you look at the last 20 years or 30 years, it's been great. But again, there's a couple points, but the Fed has been juicing this. And the juicing is going to be over when interest rates hit 0, because you can't juice it beyond 0. But the other thing is that S&P 500 number is very slanted because they're always taking companies in and out. So let's say a company goes bankrupt. They pull that out and then they change the numbers.
That's right.
So they say we don't even count this company. So the
Question
real return isn't quite what it shows.
Question for you, Peter, is do you think that the S&P 500 is a reasonable representation of the American economy as a whole?
Yeah, probably. Yes,
Now,
today. Yes.
do you think the next 10 or 15 or 20 years, the American economy as a whole will be stronger than the Albanian economy?
I wouldn't invest anywhere else.
There you go. There you
No,
go.
listen, I'm U.S. or nothing, because if there's an energy crisis and there's a inflation crisis and a food crisis, it's going to hit the rest of the world more than the United States.
Yeah.
But let me point something else out. These S&P 500 companies may be U.S. based, but that doesn't mean they're U.S. sales. That's why a lot of my dividend stocks I don't want to be in, because they might have a huge interest in China. They might have huge interest in Europe. These are not only sailing, these are international companies. And if the world goes down in terms of, the economies are not doing well, that affects these companies in many ways.
Almost every one of the S&P 500 companies has a presence in just about every country in the world.
That's what I'm saying.
Right. They're internationally
So
based.
you're buying a business when you buy a stock, and you're buying a business. Let's say you're buying P&G, right, which is a great company, and I had P&G for a little while. But today you get about a 2% dividend in the stock or somewhere around there, and the question is, will they keep growing? They have sales all over the world, and if the world is hurting,
don't ask the question. Our investors don't ask the question because we don't pick individual stocks.
No, but I'm just giving you an example of what it is. I mean, look, will all these companies? What if we're heading, which is what my forecast is, for a long period of inflation, debt, prices will go up, but what's going to happen? These businesses are businesses. They make money off the consumer. All of them, almost every one, indirectly is tied to the consumer. What happens if the consumer gets squeezed by limited resources worldwide? Then it's a change that we haven't seen in a long time.
Let me ask you, Peter, is the market a good protection against inflation? The answer is yes. You don't have to answer. Yeah. What is good protection against inflation are real assets, your home in most places.
Oh, I agree with real assets, but
not in Detroit, but
but the S&P 500 is not a real asset. A real asset is a real estate, is gold, is oil.
No, that's true. But the market is a real asset. The S&P 500 represents your part ownership of some of the strongest businesses in history.
By definition, that's not a real asset. They're finance companies. Finance company is not a real asset. They're made up of all different companies. They're not, by definition, real assets. Real assets are things you can hold. These are companies you can buy the share and you can hold the paper, but you can't. You can have gold in your home. You can live in your home. You can take oil and put it in your gas tank. These are real assets. By definition, a real asset is not a stock. That represents a share ownership in a company. And again, look, you could be right. The S&P could do very well. First of all, I wouldn't touch it right now until I see. I'm waiting. There might be a time when I might follow your strategy and say, okay, it's bottom. It doesn't.
September, October.
It's not. Let me point this out, Milan. It's not always a good strategy. In other words, if the market is going down a lot, like for instance, your strategy was not a good strategy 6 months ago because the market the S&P 500 went from roughly 475 to 375. So for that 6 months, it was not a good strategy.
If you have a friend Milan recommending his strategy, it's a long-term strategy of 10 years or probably more. And that strategy, it's in a way a defensive strategy.
Yeah.
All he's trying to do is to mimic 500 S&P 500, and that if people using the strategy can achieve that, and most likely they will achieve that.
So, do you have the S&P 500, Sasha?
No,
You don't.
I would not use it for my fund portfolio. I use it for absolutely different thing.
Right.
But in a real core portfolio, it has its place. I think that high-yielding dividend stocks probably would do better, but it's questionable because S&P 500 is well diversified. It's 500 top companies. If you hold, say, 10 high yield dividend stocks, even if two of them, for any reason, may go substantially down in price? What if one of them will cut dividends entirely because of the particular situation of
Well,
the
actually,
particular company? That's also possible.
you know,
So,
you raised an interesting point, Sasha, about you just
yeah,
said something that, you know what, as you increase your holdings, you start approaching the S&P 500 diversification, as you know.
That's true.
I'd have to look at the exact statistics, but I think if you have 10 stocks, you've already achieved something like 85%. I'm making
Well, it
this up.
depends which 10 stocks.
It's a very high, and if you own 20 stocks, I believe you're like roughly, I'm making these up, but it's very rough. But I think if you have 20 stocks, you're like 95% correlated with the S&P 500. That's so you don't necessarily need to. It's simple. It's a simple strategy. Look, if you don't want to bother to spend any time investing, you don't want to try to exceed the market, it might be a good strategy, except for not this year. I wouldn't touch it.
well, I'll tell you one thing, that if, Milan, if your strategy requires 15 minutes a week to do, strategy of following and keeping portfolio high yield dividend stocks require maybe 15 minutes a month, because there is nothing else to do. You just hold it, collect dividends, hold it, collect
That's
dividends.
true, Sasha. Once you buy those stocks, you don't have to do anything.
You don't have to do anything.
Here's a little aside, that just a little aside here, but you know, in the Fortune 500, which is different from the S&P 500, because in the Fortune 500 you have some privately held companies like Coke Industries, for instance. In the Fortune 500, the 10 drug companies that they have, big pharma, 10 drug companies, make more money than the other 490 put together. Hello.
You know, that raises a point that I heard indirectly. So we were on a show called Economics Monday on this network, and David Walker, who's was the controller of the currency, is on, along with Bob Posen, who was the former head of Fidelity. And they were talking, and David, I mean, we're heading for a Medicare crisis, which, by the way, is also maybe not going to be good for the market at all, because again, these are going to be shocks to the system, and the Medicare is supposed to run out of money, basically going into deficit in 2028. But David said something very interesting, which is, he said, what we should do now is allow the United States to negotiate drug rates. So as Medicare heads towards, this is what I got out of this. I got a few things out of that, but one thing is, I'm thinking as Medicare starts going closer and closer to default, they're going to be, well, we need to save money somewhere. So where are they going to look? They're going to go to the drug companies and say, we're going to negotiate rates. Now the drug companies are going to have to say, okay, we're going to cut back on research, so it will hurt research. But this might be a shock to these companies. So you know what? You can get a 2% yield on, or maybe 4% on Pfizer, 3% now. I mean, it was much better at 5 when you recommended it, Sasha. I should have grabbed it at 5. That was one I missed. But now you can get a 2 or 3% dividend on, you know, these drug companies. And so in 5 years, you get 10% of your money back. Now Medicare goes into deficit. And what happens to these businesses? These are businesses. What happens when the United States says, wait a minute, we're going to deficit. We've got a huge crisis on our hands, and we're going to try to milk anybody we can. The hospitals, the drug companies. Right?
I agree with you, Peter.
It's very dangerous.
I pulled out of Bristol Myers Squibb and Pfizer because of that information. Exactly.
Oh, this
what
week
said.
you pulled out?
No, I pulled out quite some time ago when I
made the same information.
A big fat profit, then pulled out of Bristol Myers Squibb and also pulled out of Pfizer. And the problem of going back in is what you just said. If there's this drug deal, it could hurt both those stocks. And again, this goes back to
hugely.
Yeah, well, it goes back to using information to your advantage. Exactly. And because you have all these things you can choose from, why choose something that's under attack? Go over to MPLX or these these energy stocks, which look like they're sacred cows now. They're not going to be attacked. And all they do is print money. What's wrong with people who just print money?
Or I feel some of my other companies are paying very high dividends, and their growth. All I want is growth, value, and a high dividend.
And a high dividend, right.
That's all I need. Right? By the way, Sasha, I think we have to wrap up, though. I think we're running out of time.
Okay. Thank you very much for participation in today's program. Have a successful trading week, and we'll see you all on next Wednesday, same time, same place.
Thank you, everybody. Thank you.
Bye-bye.